All right, we're going to go ahead and get started. Good morning or good afternoon, depending on where you are located. Thanks for joining us for today's webinar, 2016 Smith Travel Research Hotel Insights. I'm your host, Marie Strom, Director of Partner Marketing here at Stash. So we're really excited about today's presentation, and I know you'll find the content very useful and informative. And before we get started, I wanted to go over a few items. If you're having any technical difficulties, please submit a message to me via the chat window in the control panel of your GoToWebinar screen. Also, we'll be holding a Q&A at the end of the webinar, so I ask that you please submit any questions you have during the presentation into the question section of the control panel. You'll see a little arrow pointing to questions, and just click it open and place or type your answer right there. Okay, so let's get started. I'd like to introduce you to our guest speaker for today's presentation, Jan Freitag, Senior VP of Lodging Insights of Smith Travel Research. Welcome, Jan, and I'll go ahead and hand things over to you.
Great, thank you. Good morning, good afternoon, good evening. Thank you very much for joining us. I heard we have like over 100 people signed up, so I think you're as interested as I am to figure out how 2016 is going. Let me just share my screen, and then let me figure out how I can make sure that you actually see what you're seeing, what you should be seeing. So does does this look good? Are you seeing?
Yeah, you look good, Jan.
I'm trying to get to, okay, good. There we are, cool. All right, so what I would like to do with you is spend about half an hour or so, I have some 30 slides, and give you a sense of where we see the US, where the US was in 2015, talk about chain scales, talk about markets. Obviously the pipeline is a pretty big topic. And then since you asked, now let's talk about Airbnb, since everybody wants to talk about Airbnb, and then give you a forecast for this year and for next year. As you just heard, just fire at will, send your questions over. You're all on mute, but you can type them into the box, and then we can discuss them as I read them, or we can discuss them at the end. So, as most of you know, Hotel News Now is actually owned by STR, and the slides that I have here will be made available tomorrow on hotelnewsnow.com. So there's no need to scribble fastly and furiously. All these slides are going to be available. As a matter of fact, the slides that I give on every stage, I do this quite a bit, I travel and present for STR, are always available on hotelnewsnow.com. And they're free. How cool is that? Free, of course, means that we want your email address so we can send you propaganda, but I mean, it's free as in we don't want your credit card. So let's start with the US. I don't know how many of you attended the ALIS, American Lodging Investment Summit, the largest hotel investment conference in the world, actually, now. At ALIS, it is customary that the three data guys are being asked what we think of the industry, and I'm one of the data guys. So the other company was JLL, the third one was Mark Woodworth from CBRE, and then obviously me from STR, and we're being asked to share in 2 slides, count them 2, so you have much better luck today, you have 30 slides. But at Alice, we only had 2 slides. And so this is the first slide that we are asked to share in 2 slides what we thought of the industry. So this is what I came up with as slide 1. There is this fundamental disconnect between Wall Street and Main Street, between the headlines and the trend lines, between what Wall Street is thinking and what we're thinking. And the disconnect is basically Wall Street is saying, look, the party's over, let's all go run for the exits, this is it. And stocks got hammered over the last 6 months. I think they're down like 40% or so. And at the same time, I'm standing on these stages saying, wait, what now? Because we think that RevPAR this year is going to grow 5%. Now, that is true that it's not 8 like it was in 2014, and it's not 6.3 like it was last year, but it's still, hey, it's still 5%. Now, of course, Wall Street is saying, look, Jan, it was 8, then 6, then 5. We're done here. But from where we sit, it's like, wow, that's a pretty harsh reaction to 5% RevPAR growth is way above the long run average and really pretty healthy. So that's sort of the underlying current that drives everything in the industry right now. And if you read the Wall Street analysts, they're all basically saying, look, this party is over, and we don't want to be held, we don't want to hold the stocks when the party is indeed over, so we're just selling today. And we're saying, I think we have a little bit more time. So overall, these are the results for 2015. It was another phenomenal year. Room supply and room demand both grew. As a matter of fact, in 2015, we had more rooms available than ever. We sold more rooms than ever. We had more rooms revenue than ever. We had the highest occupancy, the highest ADR, and the highest RevPAR ever recorded. So room supply and room demand are both increasing, but demand growth is outpacing supply growth, and that means one thing, that occupancies are going up. You see here to the tune of 1.7%, but what's more important is that the year-end occupancy of 65.6 is actually the highest occupancy ever recorded. Well, ever in our 25-year history. And what that means is pricing power. So you see that room rates are going up to the tune of 4.4%. Now, to me, as an outsider, I'm not, I'm sort of a commentator on the industry. I'm not in the industry, but from the outside looking in, 4.4%, given these very strong demand and occupancy numbers, is actually a little lower than we had expected. We were underwhelmed by pricing power. We thought this should have had a 5 handle, like 5+%, and that just didn't happen. So we learned our lesson. We're forecasting for this year basically the same thing, 4.4% ADR growth. But whatever, it is what it is. I think everybody's making money at this point. 4.4% ADR growth falls to the bottom line quite nicely. And you see then that RevPAR, which was up 6.3%, is actually driven by ADR growth, and we expect that to continue for the foreseeable future. Now, on this chart, what I'm showing you here, this is the second chart that I had. And the reason why I'm using this is to show a couple of things. Number one, look, total US RevPAR up 6.3%. If you exclude just 2 markets, New York and Houston, which both have RevPAR growth, you actually get, for the US, for the remainder of the US, RevPAR growth of almost 7%. And the reason, so number one, the majority of markets did better than the average, the 6.3%, if that makes sense, because New York and Houston actually account for, I think, around 7% or so of demand. The reason why I'm using this chart, more importantly, is because half the room at the ALIS conference, which takes place in LA, is from New York. Looking out their windows, and they're seeing cranes, and they're seeing 14,000 rooms under construction, and they're saying, oh my God, we're all going to die. And the truth is, no, that's just New York. New York occupancy has been positive for 4 or 5 years. So it has been, not positive, it's been positive forever. The occupancy has been over 84% for the last 4 years, and there just is no pricing power. So there's a lot of demand, but in New York City, it's just this odd outlier where with high occupancies does not come pricing power. And so I use this slide just to say, look, guys, you're the anomaly. The U.S., so New York is not the U.S. And I emailed that line to an analyst I know pretty well, and he emailed me back the word nonsense. And that's sort of, and he was joking, of course, but that sort of gives you a sense of what people think about the U.S. performance. As New York goes, so does the nation go, is what they're thinking. I respectfully disagree with that statement. So here is where we are right now. What you're seeing here is the supply percent change and the demand percent change back to the beginning of time, according to Randy Smith, which is 1990. And you're seeing this on a 12-month moving average basis to eliminate, to basically smooth out the data. And what you're seeing is the red line is always above 0. We always add more new rooms. The only time when that's not the case is actually there's one dip between 2000 and 2010. It's actually exactly in 2005, and that was Hurricane Katrina. Katrina was so strong, it took out so many rooms that we saw that in our nationwide annualized supply growth numbers. But other than that, you see supply is always positive. You see demand dips and ebbs and flows a lot more strongly than supply does. You're seeing the last 3 recessions very nicely here, 1991, 9/11, and 2009. You're seeing that demand drops every time more steeply. You also see that the rebound in 2010 and 11 was very, very strong, and then sort of came down, the growth slowed, and then in 2014 there was this hiccup, this positive push, because group demand came back. So the rebound in 2011 was all transient travel, and then after a while, corporations, Fortune 2000 corporations said, oh, look, we're fine. Let's go travel. Let's put our people back into conference centers and conventions. And so we saw this nice uptick from group, and now you see the blue line is coming down. That does not mean that we're selling fewer rooms. It just means that the growth of demand is slowing. So we're selling more rooms than we ever have before. It's just the pace of that growth is slowing, and you see the red line, which is the supply growth number, supply line is slowly inching up, you know, and slowly means we're seeing a lot more new supply month over month over month. It was slow. It will ratchet up here pretty quickly, and eventually those two lines will meet. Blue and red, supply and demand will equal. The growth rates will equal, and that means mathematically that occupancies will be at zero. Occupancy growth will be at zero, sorry. And then the question is what happens with pricing. And we'll talk about that in a little bit. I don't know what the answer is to that, by the way. You are the ones out there telling me what the answer should be. But as supply and demand growth even out, we will see occupancy growth, you know, coming, slowing, and then eventually being zero, and eventually being negative. And then the question of cost, of ADR, of pricing, that's the big question. And then if you put that all together, supply and demand makes occupancy, occupancy and ADR then makes RevPAR, you get this chart. This is the RevPAR percent change by month back to 1990. And what you're seeing again, you see the three recessions, 1991, 9/11, and 2009. And you see that we are now 71 months into positive RevPAR growth territory. And I can understand why the Wall Street analysts are saying, look, Jan, the last cycle lasted 56 months. This cycle is 120 months, sorry, 111 months. We're kind of done here. I'm like, yeah, but we're not really done yet. Eventually we'll be done. But so that's, you know, they're sort of early to the exits, as some analysts have talked about a bear market for a long, long, long time. Now, you know, we respectfully disagree. We think that RevPAR growth this year is going to be positive, next year is going to be positive. So we still have at least 18, if not 24 months of positive RevPAR growth ahead of us. But I get why people are a little skittish. They're also skittish because of this chart. And this is a little bit fun with numbers, and I'm calling this why Wall Street is so blue. When you talk to the analysts and we talk about positive RevPAR growth, they're actually not looking at the RevPAR percent change, which is on the right-hand scale and in orange here. What they're looking at is the growth of growth. So in January of 2016, which is the far right-hand side, you see that RevPAR growth was, pretty small, 2% or so, 2.3%. That is actually 60% lower than it was a year ago. So last year, you know, it was, I don't think, like 8 or something like that, or 7. So the point is, look, Jan, is what the analysts tell me, we don't care about the absolute value. We see a trajectory that goes from 8% growth to 6% growth to 4% growth. So the growth of growth, what we call the second derivative, is negative, and that has us running for the exit. And yeah, I get that is indeed correct. But my argument is still, wow, look, guys, we're still growing RevPAR. But that's not what they want to hear. Now, that said, here is actually the January data. And so room supply outpaced room demand in January. We had Winter Storm Jonas, which put a pretty big damper on travel for a while there because people just couldn't get out or in wherever they wanted to go. And then at the same time, January is sort of a slow group travel month anyways. So overall, not great. And so occupancies declined, and room rate growth was only 2.8%. So RevPAR growth was only up 2.4%. So our friends from Wall Street basically told me this, which is, I told you so. You know, we at STR keep saying, look, 5%, 5%, 5%, and they're saying, yeah, not so much, not so fast. Now, I have a counter argument to that, and we'll get to that in a second. I think Q1 is just going to be weaker than expected, and after that, it's going to be fine. But for now, the Wall Street guys prevail, I guess. So let me switch gears and tell you a little bit about the chain scales. As most of you know, we break out the universe of chain affiliated hotels into these buckets, for the lack of a better term. And you see, so luxury is like St. Regis and Ritz-Carlton and Four Seasons and so forth. Upper upscale are the big meeting boxes, you know, 300, 400, 500 room hotels with large meeting space, the Marriotts, the Hiltons, the Westins, the Sheratons, the Gaylords of the world. Upscale are your, you know, your Courtyards. Upper mid-scale is your Holiday Inn Express, and so forth down the food chain. And you, most of you are independent hoteliers. You sort of fit into those buckets as well. This is not exactly your data, but you can think about yourself as either luxury or upscale or economy, and then you can see what your chain affiliated brothers are doing. And you're seeing that overall, look, you know, it was pretty healthy performance in 2015. That overall, and what I'm showing you here is the ADR percent change stacked onto the occupancy percent change, which actually together, if you sum that together, gives you the RevPAR percent change. And you're seeing that, look, no big surprise that the RevPAR percent change is actually driven by ADR percent change, and that the upper end of the market actually doesn't see a whole lot of occupancy increases. And why is that? That's because the upper end of the market is already full. What I'm showing you here is for luxury, upper upscale, and upscale is that the year-end occupancy basically means that they sold 7.5 out of 10 rooms, 3/4 of all rooms, every night last year. And if you know, as you know, that Sunday is a 50% occupancy night, then to get on a monthly basis to 75, or an annualized basis to 75, that means you're really full Tuesday, Wednesday when the business traveler is on the road, and Friday, Saturday when the leisure traveler is on the road. So this is very, 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 very strong performance. Now, for you as an independent property, when you compete with the brands, your mileage may vary, and that's why in this part of the cycle, there's a high likelihood when you look at your comp set, it could be that your RevPAR growth is actually outpacing your branded competitors, just because you can make up more room on the occupancy percent change. Your ADR percent change may actually be the same, but because you're not quite as full, statistically speaking, and again, your mileage may vary, but on average, an independent hotel is not quite as full as a chain affiliated hotel. So if you want to if you're looking at your data, it may look like your RevPAR growth is stronger because you can still grow more occupancy, you know, and that's, I think, part of why I'm presenting to you today. You know, Jeff and I have these conversations on an ongoing basis. You know, what's the value of a loyalty program? Obviously, you want to build more occupancy, and especially now as hotels are full and people are saying, oh, I can't get into this hotel, where else could I look? You know, or I want to continue to be with the independent property, you know, give me another incentive. That's obviously where Stash comes in. Let me switch gears and talk to you about markets. So what I'm showing you here is for the full year, the best and worst performing markets. We have 168 markets in the US, and we break it out. Most of them follow the MSA designation, but then as you get into rural areas, you get, you know, Texas South and so forth. Who won? San Jose, Oakland, you know, California North. I mean, everything around San Francisco is just on fire. Tampa, St. Petersburg did very, very well. Who lost? No big surprise. North Dakota, Texas West, Texas South, Oklahoma, New Mexico South, West Virginia, Texas North, Houston is all oil related. As long as oil is so cheap, there really is, nothing to be had. And those markets are arguably overbuilt because we had a lot of influx of rooms coming into the markets. Now, two charts on two specific markets just because they are in a lot of people's minds. First one is New York City. What I'm showing you here in blue is the absolute level of occupancy. And as I said, for the last 4 years, basically 84% occupancy. That's amazing. I mean, 75 for luxury and upper upscale hotels is amazing. For a market to run 84% is unbelievable. I mean, that means you're basically full Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, and Sunday. You're basically running a 70% occupancy or so, which is just unheard of. So New York City is alive and well, except then you look at the RevPAR growth in orange and you're seeing, wait a second, 12 to 6 to 6 to 4 to 2 to -2. What is going on? No pricing power whatsoever. And this is the conundrum. This is where people are saying, Jan, explain this to me. And I can only say, I am not sure. Yes, there are 14,000 rooms under construction, and we already have opened, 4,000 rooms or so last year. Yes, the strong dollar will make it a lot more expensive for Brazilians and Europeans to come. And yes, there's Airbnb there, but all of this is sort of just part of the answer, and I'm not sure what the real answer is. Hoteliers just don't feel like they have pricing power in New York, which is just weird. So I don't really have a good answer for you other than say that you would expect differently. Now, the next chart is Houston, and this is just basically fun with numbers. What I'm doing here is on the left-hand scale in red, I'm charting the oil per barrel, sorry, the dollar price per barrel, and you're seeing it goes from $100 to $35, and we're overlaying there on the right-hand scale demand percent change, and oh wow, no big surprise. As the price of oil goes, so does room demand, and so it's going to be interesting to see where we go with that. If oil is stabilizing, does that mean there's actually more room demand, or are we having a new normal? It's very much a reset in the Houston market. So stay tuned for that, but that is certainly an ugly, ugly, ugly chart. All right, let's talk about the pipeline real quick. So yeah, the pipeline is accelerating. No big surprise. The pipeline, or the number of rooms under construction, 141,000, is up 17%. If you look out your back window, there's probably a crane, right? Somebody is building. 141,000, that sounds like a lot. It actually is a lot, but it's not as much as it was in Q2 of 2008 when it was roughly 200,000 rooms. So we're still not at the prior peak, but overall you see the final planning numbers up 50%. You see the under contract numbers up 14%. So yeah, there's a lot going on in the pipeline. The growth rates are accelerating. Now, what gives me pause is this chart. So this breaks out the 141,000 into its chain scales. And what you're seeing is that everybody and their brother is building another limited service hotel. So upscale, upper mid-scale, 70% of all rooms are in those two chain scales. And as I said, those are your Courtyards or your Fairfield Inns, Ramada Plaza, Doubletree Club, what else? Comfort Inn, Radisson, those types of properties. So what I don't like about this chart from an industry observer perspective is that it's, I think we're painting ourselves into a corner. There is very limited full service supply coming. People don't build any more ballrooms. And as we have group demand recovering, it's going to be harder and harder and harder for those groups to meet anywhere because we don't build any new hotels. And it's really hard to have, your 1,000 or 500 person meeting at the breakfast buffet of the Courtyard. That's just not going to happen. So where are they going to meet? That is sort of a question I think that's going to be interesting to follow going forward. But right now, limited service is the name of the game. Wall Street loves them. Owners love them. Brands love them. Obviously, they're the workhorses of the publicly traded brands. That's where the action is. Let me talk briefly about Airbnb. That's obviously a big topic. And for the first time, Airbnb actually shared data with a third party. It turns out the third party was STR. So every other article that you've read so far from CBRE, from HVS, from the New York Hotel Authority, from the American Hotel and Lodging Association, all that stuff was not from Airbnb. They used third-party data. So for the first time, we got that data, and we published a bunch of articles. The first one, I'm showing you a screenshot here, Airbnb's impact minor on Manhattan hotels. And man, you would have thought we imploded Twitter. So you should definitely read the string of commentary under this article, and not a lot of people were not very happy. A lot of people weren't very happy, I should say. And our president, Amanda High, to her credit, is basically answering every single comment. And the point is, look, this is for the first time some data. Shouldn't we be happy that we actually have some real data? It turns out that there are a couple of interesting findings when we looked at the Airbnb data. For example, the average length of stay is 7+ nights, so really geared towards the long-term stay guest. But the other thing that we found interesting are the next two charts. And this is not Airbnb data. This is, again, just Manhattan STR data. And so the number one thing is we said, look, if there really is a pretty big impact of Airbnb on a specific market, you would think it happens when the market is full, so that there is a decrease in the number of nights that are running full occupancy, what we call 95% or more occupancy. We call those compression nights. And so what we did is we just counted compression nights, and you see that, look, the average is 50. In 2007 it was 65. In 2008 it was 37. In 2014 it was 78. In 2015 it was 52. So is that 2014-15 a clear indicator that Airbnb is stealing compression room nights? In my opinion, and where we sit in Hendersonville, Tennessee, y'all, we have this saying, one data point does not a trend make. And so ask me in 2016, but you see the drop from 65 to 37 happened way before Airbnb. So the drop in 2014, 78 to 52, could that have something to do with the new supply? Probably. Could that have something to do with, less Europeans, less Brazilians coming? Maybe. Could that have something to do with more Airbnb units? Maybe. But overall, I think in 2015 we were still above average, above the average for the time period. So we think that, this is sort of inconclusive. And then the next chart shows you, okay, if it is a compression night, how much more do hoteliers charge during a compression night, as they should, right? It's called yield management, versus a regular night, a non-compression night. And the answer is, look, it's 28% more, and it has been 28% more. So no impact on pricing that we could discern during compression nights. I think this is a really compelling slide. I think it's a very compelling story to say, look, the hoteliers yield manage, and they do so very well. And even though there's new supply and there's the three things I just mentioned obviously still hold true: more new supply, less European travelers, and more Airbnb rooms. But obviously hoteliers are saying that's fine. We're still going to increase our room rate during compression nights by about 30%. Now, the other thing, when we looked at the Airbnb data, what we found is, if you overlay the Airbnb average rate compared to the hotel average rate, is that the hotel average rate is a lot more erratic. Now, erratic can be interpreted two ways, and really only one way, but what it means is yield management. As demand ebbs and flows, so do room rates. What was fascinating to watch is that the Airbnb room rate did really not change. If you look at hotel room rates in Manhattan over a year, it's sort of like a squiggly line, it goes up and down, up and down. For Airbnb, it's a flat line. It seems like Airbnb hosts sort of pick a number and then they stick with that number no matter what the room demand is. So they have virtually no yield management to speak of. So anyway, I thought this was really, really interesting. I urge you to read that article and have a look, and make up your own point of view on that. So then let me finish. Let me finish with the forecast. Oops, sorry about that, Chief. First of all, what's important to note? Look, Q1 is going to be weak. Why is that? Because April is shifting to March, and when Easter shifts, so the March data is going to be weaker, which means Q1 is going to be weaker, especially because January already was a little bit weaker. So, that's just, hey, heads up, this is going to happen. The Jewish holidays also shift by quarter from September to October, from Q3 to Q4. So all of that you should just take into consideration as you look at your data. April and December will have 2 more weekend days, which is a good thing, and May will have 2 fewer weekend days, which is a net negative. And then, by the way, Leap Day, February 29th, we actually take that out of our results. We show the monthly data as if it only had 28 days. This does not affect the weekly data, but if you're a subscriber to STAR, this well, I should say it doesn't affect the monthly data either. We normalize February to only have 28 days. So 2016 only has 365 days for us, just because otherwise, wow, the year would be amazing because we had, an additional day in it. So this is just a heads up. This is sort of inside baseball stuff, and if you want to read more about it, read the STR leap year methodology PDF. I show you the URL on the bottom here, but it doesn't really matter. Now, here's what matters, which is our forecast. We're saying, look, it's fine. It's going to be fine. And it was really good, and now it's still good. Demand growth, healthy. Supply growth, picking up. Occupancy growth, still a little bit, meaning new occupancy record. And with that comes, as I said before, pricing power. Our room rates are going to go up 4+% or so, driving RevPAR up to 5. Now, let me be honest. We are the bears in this scenario. If you CBRE and PwC, they're both saying, look, Jan, you don't know what you're talking about. The occupancy is at an all-time high. That must mean pricing power to the tune of 5+%. I hope they are right. I really wish that you out there in Radioland prove me wrong, and that it's not 4%, that it is indeed 5%. You use all the yield management and demand expertise and increase room rates more than what we have seen. Now, as I said, we'll see what happens. 2017 is basically the same picture. So supply and demand are basically in equilibrium, and towards the end of 17, those two lines, the annualized supply and demand lines, will meet, and then occupancy will be slightly negative. But room rate growth still in the 4%, because keep in mind, we're at record levels. Even if the occupancy drops a little bit, we're still well above where we were in 2007. So all is, well, and so RevPAR growth going forward should be also pretty healthy. And then let me finish up. If you're Downton Abbey fans like I am, this is what we tell analysts who don't believe our 2016 RevPAR forecast. Don't be defeatist, dear. It's very middle class. So with that said, let me finish up by just doing a very, very quick plug for, if you like data, and if you've listened to this now for the last 40 minutes, I think you really like data. You should be better at reading data, and we now have something called the CHIA, Certification in Hotel Industry Analytics. If you want to know more about it, email us, email the Share Center at str.com, and we give you some more information. So with that, I am ready for questions. Thank you so much for your time.
Thanks, John. Yeah, we've got a couple of questions that came in. Let's see. First one is the RevPAR growth of 2016 more heavily weighted toward the earlier part of the year? And there's a part 2 of this question. Will the end of 2016 start to close the gap on performance expectations as we move into 2017?
Yeah, I think you just answered your own question.
Yeah.
So, is it front weighted? No, it's back weighted. Q1 is going to be weak. Q2 is going to be a little better, and then Q3 and 4, because the comps are easier, should be better, and so it's back end weighted, I guess is the answer. And then what was the question about 2017? Like, does that get us into an easier 2017, or that sort of sets the tone for 2017? Yeah.
Will the end of 2016 start to